Hello, Swing Chat. I thought this morning I would do a video on the differences between trend trading and mean reversion trading. Often I think that causes a lot of confusion just because the strategies in which you trade are completely different. As you know, I'm primarily a swing trader, although I do dabble sometimes with day trading. But generally, I'm a swing trader that focuses on trend following, or also known as momentum trading. What does that mean? So, what momentum trading is, or what trend following is you look for a trend, and these can be spotted quite easily with charts. Looking at this chart, ARWR, you'll see all the way from the beginning of the year, right here, January, up until now. We've pretty much been up and to the right. Now we do have pushes up, consolidation, push up, consolidation, push up, consolidation, push up, consolidation, etc. And I've described that as the ABCD pattern from time to time. But generally, what you'll see is a rapid push up, an area of consolidation, and that usually means accumulation. It means more people are buying in and holding and waiting, and then when it does break above that B point, we have another push up and then another period of consolidation. So trend trading is very simple. You look for stocks that are trending, and then you wait for a buy. Now, it's never good to buy at the end of a push up. Once a stock has gone from the A to B, the C, and then the C to the D leg. In this case, ARWR pushed up, consolidated, and pushed up again. I was getting questions last week. Hey, should I buy here? This stock has been up almost 15% in 2 days. Is that a good time to buy? Absolutely not. Even if you're a trend trader, not a good time. It's usually good to let the stock rest a bit, and then you can buy it during that consolidation. Now, sometimes consolidations are flat, like this. Sometimes consolidations are ascending, and you just really just have to start to recognize that. And the ABCD pattern is it's fundamental to trend trading. Now, the important part of trend trading is that you are following the right stocks, or you're watching the right stocks. And a lot of the stocks that I talk about all the time are trending. They're up and to the right, and you can see that very clearly on the charts. Looking at CVNA, here we go. We've had quite a good run from the beginning of the year. Now, sometimes trends do break down. So what you want to do is kind of be careful and watch that to see if the pattern breaks. Looking at earlier in the year, you'll see, later last year, you'll see this trend up, and then the pattern actually did break right at this point. So that's a time to stay out of it. But later in earlier this year, we did find. Sorry, I had my timelines wrong a little bit earlier, but earlier this year we did find. Another trend up. We've had this consolidation. So again, as we're breaking out the new highs, that makes CVNA a good target. Now, also additionally on trend following, I find the weekly time scale, or the weekly chart, where that means one candle equals a week rather than one candle equals a day, as a good way to recognize trends. Even though this chart, there is some volatility right here, overall the picture is up and to the right, and that's the same thing with ARWR, CrowdStrike, Smartsheet, Team. You see all these have this nice up and to the right trend. Now, if you look at others, let me pull up Tesla. There's no trend here. Now, I mean, we've had, it was trending in the past, and then that trend was broken, and then we had this long period of consolidation beginning 2017, and now it sort of looks like we're on a downward trend. That's why you don't see me going long Tesla. Sometimes I may short Tesla, but definitely would not go long Tesla just because it's not part of the trend. So that's trend following in a nutshell. And usually with trend following, all you have to do is buy and wait. And if you are trading a trending stock, you really can't go wrong. Now the problem there is you need to define the time frame that you're trading. So are you a day trader? Are you a swing trader? Are you a longer term swing trader? For example, do you swing trade over a period of a year or a quarter or a half year? Something like that. So that also has something to do with it. Now, if you are constantly adjusting the time frame that you trade, that's not really a good foundation for you to make good decisions on how long you stay in a stock. Now, I have mentioned in some of this more recent volatility that I love to go back and look at the weekly time frame to see how we are faring, and is the trend broken on the weekly time frame. And if the answer is no, you can be a little bit more confident in your position, especially if you have you're using a longer term viewpoint. The other thing, you can use trend following ideas or thoughts for day trading. For example, so only day trade long companies that are in an upward trend. That's I've said several times, having the wind at your back, and that's what that means. But generally, in this time of, we've had some volatility recently on the QQQs and the SPYs, etc. And, but we're still upward trending. We're not in a bear market yet. So, it's important not to be overly bearish too quickly. However, it is a time to be cautious because, there is a time that you're fully invested when trend following, and then there's a time where you need to lighten up a bit. And when markets are choppy, that's the time to lighten up, because that's actually when trend following is not profitable. You will be stopped out over and over and over and over, and if that's the case, that all those tiny cuts right there will eventually be fatal if you're not careful. So, there are a number of trend followers that actually do not even go in the market during certain conditions. For example, that condition may be if the stock is under the 50-day moving average, or if the stock is under the 200-day moving average. For example, if you had that rule as a trend follower, you pretty much would not have been in the market for the last 2 weeks or 3 weeks. And how have you done in the last 3 weeks? I'm sure you've had some okay trades, but you're probably not breaking records right now, and that's just because the market has been very volatile. And so if you define yourself as a trend trader, you need to recognize that during volatile times, you either need to not trade or take extremely small positions, so that if you're trying to catch the bottom, that's okay. I mean, there are times to do that. And I definitely understand. It can get boring just completely setting out forever. But you don't want to be all in. You don't want to really be putting much capital at risk at all during these volatile times, because that's when trend followers get eaten up. Now, when a trend is happening and the overall market is running, and then you're in these high flyers that have been trending up, you will outperform day traders, mean reversion traders, etc. So, so while a market is chopping, if you have the discipline to stay out fully or stay light, and save yourself for the trend, for the setup, then you'll be positioned to win big, and when it's time for that. But I can tell you right now, it's not time for that right now. It is time to trade light, and it's annoying. Sure, I get it. I'm annoyed by it as well. But now there is another strategy I want to mention. Or talk about. I mentioned earlier, which is mean reversion, and that's just the idea that that a stock will become overvalued and then it'll return to fair price again. And it's a completely opposite style of trading from trend trading. Now, sometimes I do get the question, hey, this RSI on this stock is extremely high. It's overbought. Why does it keep going up? Well, that's a trending stock, and an RSI indicator is an oscillator centered around, just simply put, centered around mean reversion, and can help you understand when something is overbought and oversold, etc. And it doesn't always work well on mean reverting stocks. I've actually heard that there's some traders that when a stock is if you're trading a trend following stock using RSI, you actually do the opposite. You buy when it's overbought and you sell when it's oversold, which is opposite from mean reversion, which is you buy when it's oversold and you sell when it's overbought, etc. Hopefully I have that right. So just to kind of define mean reversion a little bit more. That's the style I see Ricky using a lot on the ETFs. If I look at UWT, for example, on let's just go like on an intraday chart. These ETFs generally are mean reverting, where if you do buy, look at the RSI when it's oversold. If you do buy in this oversold area, and then you sell in the overbought area, you're gonna do well. If the stock is acting in a mean reverting way. However, when you're trading using a mean reverting style, if a stock is trending downwards, if there is a broader trend and it's a strong trend and it has less mean reverting qualities, you will get killed. You'll buy when it's oversold and it'll keep going down. And I'm sure all of you have experienced that. I don't know if I can find any good examples quickly, but let's see. Probably not going to find any really good examples on a short term, but you all have, I'm sure, definitely have experienced days where no matter what you do, if you're buying when the RSI is oversold and the MACD is favorable, and the thing just continues to go down, so in that case the mean reverting strategy doesn't work. But generally, mean reversion will work on assets like UWT, DWT, etc. They would not work favorably on on more trending stocks. Now intraday they may, but on a day-to-day chart, if you are trading, you're going to have trouble, because things that seem overbought keep going up, because these stocks continue to make continue to make higher highs, break out to new highs, etc. So, I'm not sure how well I've explained this, but hopefully I have introduced you to the concept that there is different styles of trading. In the sense of there's trend following as one style, and mean reversion as a different style, and they're two completely different approaches. So during these choppy times, if you're taking a more trading approach, it's important that you recognize that and then adjust accordingly by not trading or by trading smaller. And then if you're trading mean reversion, that style actually will work better in these choppy times. However, later on, if certain stocks are trending and you're trying a mean reversion strategy, then that won't work. So it's important to know how each work, how you can trade each, and then use your playbook as you defined. So hopefully that's enough to get you started, and I do highly recommend that you do further research into trend trading, and as well as mean reversion trading strategies, and just so you can recognize a little bit more about what you do and how you're doing it, and if you're applying the right indicators or not using indicators like RSI if you're trend following. They're just recognizing that, and then also again, kind of define your time frame. Are you are you more of a longer term swing trader? And if that's the case, these are the times to stay out. Or are you a day trader where volatility is good, and these highly volatile times actually are great conditions? If you were Friday, if you were going short when we had this big down day, you could have made a boatload of money that day. But I typically don't day trade much, and I also don't go short as much as well. So my way to approach that is just kind of sit on my hands. So hopefully, and that's how I mitigate risk myself. So hopefully that was helpful, and I look forward to hearing what other questions you all have about this. Thank you. Bye.